Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we are going to be doing a four-part review on what's happened in this most recent downturn that started on February 20th with the negative reversal in the S&P 500. So part one of this little mini-series, if you will, in kind of reviewing is what's been happening in this downturn. We're going to be looking at equities, and we're going to start really with the S&P 500 and then take a look at some other equities, both U.S. as well as around the world, to see on a relative basis what has worked and what hasn't. On part two of this series, we're going to be looking at the S&P 500 versus gold and miners, and also bonds, high-quality U.S. government bonds during this downturn, and how those have all worked. In part three, we will be reviewing the underlying sectors of the S&P 500 to see what has worked and what hasn't, and on a relative basis, what sectors have held up better than others. And then in part four, we will be talking about where we go from here. So we'll be doing traditional technical analysis on the S&P 500 and taking a look at statistical probabilities and where the markets might go from here. And for our charting service, we will be using stockcharts.com. I do pay for this service, and I will leave a link to their site in the description box below this video. So to start off with, let's kind of review what has happened and where we've been. So we hit an all-time high in the S&P 500 on February 19th, closing at 3386.15. And the reason I have this blue line drawn on this chart, and by the way, this chart is a 1 month chart. So you can see we're going back 1 month, and each candlestick represents 1 hour of trading in the S&P 500. I drew this blue line to show us where the 3380 mark is, because the on February 19th, when we closed at 3386.15, which again was the all-time closing high on the S&P 500, it's the only time we have closed above 3380 on the S&P 500, the only time in history that that has ever happened. And what we can see here is we made this all-time closing high, and then we had a negative reversal on the very next day, on the 20th, on Thursday. Okay, and then we closed towards the low of the session on Friday. Now, I had been warning my subscribers, and again, Simple Market Signals is a proprietary model that I built for my own personal trading and investing. And then once I realized what I had, I built a business around it to share that data with you guys. And what I do is I write a weekly financial services newsletter, and it's built around the Simple Market Signals, but there is a ton of other information in this newsletter. And I had been warning my subscribers for weeks that one of the indicators in my model was at its peak, at the level that it normally hits before it rolls over and before we have a downturn. So I had been warning people for several weeks in this area here, and even before that, the likelihood of us continuing to go up was starting to get minimized, all right? Because that indicator within my model, and there's numerous indicators in the model, but that particular indicator was at one of the highest levels that it ever hits before, and then, the next thing that happens is it rolls over. And when it rolls over, we generally have a downturn, and you never know how bad it's going to be. Sometimes it's just a few percentage points, but when you couple this type of an action and that indicator being maxed out with the coronavirus, this is the type of thing you get, okay? So I'd been warning people, and then I warned people about the negative reversal on Thursday, the close on Friday, and then this gap here, that's the weekend right here. I had been telling people that they better be ready to go to cash for those momentum traders that do that like I do. I'm either fully invested or I'm in cash. That's just the way I operate. What you do is up to you, but I just want to kind of walk you through, number one, how I can help you, and what Simple Market Signals is, so there's clarity on that. It is a weekly newsletter that I send out. I send it out generally on Saturday mornings. I try to get it out before noon Eastern Standard Time on Saturdays, but it really helps you. And guys, it's less than $20 a month, okay? And there is a ton of information in there. And for most of you, I can promise you, it is costing you money not to be a subscriber. Because look at this, this downturn. We'll walk through the math of this, but I just want you to understand what has happened in the markets, but also kind of, bring you into my world, if you will, so you understand how I can help you beyond, my free technical analysis charts, right? Because Simple Market Signals goes way beyond traditional technical analysis to give us a real risk model that shows us the risk level in the markets. And you have to go beyond price action to understand that, okay? So anyway, so we know that we hit this all-time high on the 19th at 33.86. We had the negative reversal here on the 20th, all right, which what that means is, when you hit an all-time high, you want to see follow-through, all right? But we didn't have that. We hit this all-time high, we broke out, and then the very next day, around 11 o'clock, I remember, because I was looking at the intraday charts, the really, really short-term charts, but we broke down and had that negative reversal here, okay? That was the first sign that something wasn't right. Now, the good news is we closed above 33.70 here, so at this point, all right? So that was good, but the very next day, we gapped down again and closed at the low of the session. So we had several early warning signs right here, even beyond looking at my model, just in the traditional technical analysis. This right here was a warning sign, all right? And then you couple that with the negative news of the coronavirus. We had more negativity over the weekend. You see the gap down on the 24th, which was Monday. And then, again, we closed towards the lows of the session, and then that action continued for the entire week. We hit our so far now, okay, and this is super important for you guys to understand, so stay with me. This low point that we hit a week ago Friday, right, so this was February 28th, the intraday low was 2855.84. Now, the reason that is so important for you guys to memorize is that that was 1/10 of a point below the monthly low, the intra-month low, if you will, for the month of October of 2019, okay? So far, all we've done here is we've intraday, right, Friday a week ago on the 28th, we undercut the October 2019 lows, which was 2855.94. Again, right here, that was 2855.84, okay? And then we bounced off of that, and then we had, on a relative basis, a halfway decent, all things considered, guys, all things considered, we had a relatively decent week last week in that we actually closed up 0.61% for the week, and and we traded kind of mostly sideways, really, between, most of the action was between 3,000 on the bottom and about 3,100, 3,120 on the top, as you can see here, okay? And then we broke down a little bit on Fridays, and Fridays have a tendency to be kind of a down day anyway, so it didn't surprise me, and especially with all the uncertainty around the global stock markets, the coronavirus, the economy, the uncertainty about earnings. There's a lot of unknowns out here, and so it's not unusual in this type of an environment to see traders and the algorithms not want to be long, right? Not want to own equities, or at least have huge equity positions going into the weekend, because there's just so many things that can happen over the weekend that can hurt you. So, we did see that on Friday, and of course, the good news is we didn't, we still stayed above the, Friday lows from the week earlier, and we closed near the session highs on Friday, if you can see where my cursor's moving. Again, each candlestick here represents 60 minutes, 1 hour of trading in the S&P 500. So that's kind of where we've come over, this period of time, okay? And again, Simple Market Signals, I was warning people up here that things were peaking. I gave numerous, in the weekend newsletter that goes out on Saturday, I gave people warnings. And by the way, I send what's called special midweek updates when things change, when signals change in the model. We had one go out here. We had one go out, several times. So there has been 3 times that I had intra-week special midweek updates, which is very unusual. But there was 3 different warnings for my subscribers to take profits and let them know that way beyond price action, the model itself was showing that this is a very, very dangerous market. Now, with that said, let's move on to and talk about diversification and look at several different investments. And we're going to be predominantly using ETFs here to represent different groups of investments in different areas of the world. But what we're looking at here is how the S&P held up and how it performed since February 19th. Okay, so hopefully you guys are looking at this on a larger screen because there's a lot of data. But so what we're going to look at here is just the last 13 days. All right, so we're going to start with February 19th through the 6th of March. I am making this video for you on pretty early on Sunday morning here, March 8th, but I just had this idea and I wanted to share it with you. So we're just reviewing the last 13 trading days, and it's kind of a, it's kind of a, I mean, it's just amazing that just 13 trading days ago, right? 13 trading days ago, we were at an all-time high, and all of this has happened in the last 13 trading sessions. It feels like it's been longer than that, but it's just been 13 trading sessions so far. But so what we're looking at here on the far left in the red bar, that is the S&P 500. And what we can see here is that the S&P 500 in this last 13 trading sessions is down 12.08%. The Dow Jones Industrial Average, which we're using the ticker symbol DIA for that, that ETF, that is down 11.74%, so not a huge difference. Again, what we're reviewing here is what has worked, and on a relative basis, what, how far is something down versus something else. And I think it's super important for you guys to understand this, because there hasn't been really, especially in the equity world, there's really been no place to hide across the globe. Everything is down, and this comes down to talking about absolute versus relative performance, okay? And what I mean by that is, let's say, and this will make more sense as we go through the video, so just stay with me here, guys. But, if you have something that's down 10% and something else is down 5%, well, they're both down. You lost money in both investments, but yeah, the one that was down 5% on a relative basis, with hindsight, as a benefit, was down half as much, but you still lost money either way, all right? So I try to operate on absolute returns as much as humanly possible, and that's why I built that model for myself. I hate going backwards. I hate losing money. I want to make forward progress, and I don't want to take any more risk than I have to per unit of possible return, okay? So that's kind of what this is about, is, what has worked, what hasn't worked, and on a relative basis, over the last 13 trading sessions, what have we experienced? Okay, so again, on the S&P 500, by the way, we're using SPY. We're down 1208 there, and then on the DIA, the ticker for the ETF for the Dow Jones Industrial Average, which, by the way, there's 30 stocks there, 500 in the S&P 500, of course. The DIA is down 11.74%. The triple Qs, which is the NASDAQ 100, is down 12.22%. And then over here, now these next three are going to be international investments, and this one here, the pink one where I stopped my cursor, that one's down 9.27%. That's the EEM, that's the Emerging Markets ETF. That's down 9.27% over the last 13 trading sessions. So you can see it's down a little bit less, but still down all the same. And then, believe it or not, in this, intuitively, I wouldn't have thought this, but this investment here, the FXI, is an ETF that tracks Chinese large caps. And at last count, there was 50 large cap companies in the FXI. So it's tracking 50 of the largest companies that are in China. And it's down 5.20%. Now, with the coronavirus, kind of the epicenter for the coronavirus, as far as we know, being China, you wouldn't think this to be the case. But here we are with the Chinese large cap down less than half what the U.S. investments, be it the SPY, the DIA, or the triple Q, the FXI is down half as much over the last 13 trading sessions. And guys, I know this is a short period of time, but this is the type of work that I like to do for myself, and I wanted to share it with you just to kind of see what really has happened since we peaked on February 19th through this last Friday, March 6th. And then moving on here, this investment here, now this is the MSCI World XUS index. So it tracks 22 large countries, right, around the globe, minus the United States. So it's 22 countries excluding the U.S., so there's 22 countries in here, and there's over 1,000 investments, and it covers 85% of basically the world's market cap, all right? So the market capitalization, and you can see here that the MSCI World XUS index is down 10.27%. during this last 13 trading sessions. So what we know here is that you lost money, period. Okay, in the equity world, you lost money, period, over the last 13 trading sessions. All right, and I'm going to back this up just before we drop off of this video and move on to session 2, which again is going to be covering S&P 500 versus gold versus government bonds, U.S. government bonds, to see how those have performed during this same time period. But I think it's important for us to understand that regardless of what a person was invested in over the last 13 trading sessions, you lost money, okay? And this again is, I try to, remember, cash is an asset class. And years ago, and keep in mind, for those of you that don't know, I have a 20-year background in financial services. I was a financial advisor. Before that, I was a vice president and regional sales manager for Oppenheimer Funds, the mutual fund company. I have 25 plus years of trading and investing, trading stocks and options. And then, I've been investing in 401ks and things like that through my job since the 80s. All right. So I've been at this a while. And during a trading session that I went through when I was with Oppenheimer Funds, we were going through some training from a guy named Roger Ibbotson, and he is huge in financial services. And Roger Ibbotson pointed out that cash is an asset class. So I want you to understand, it's not just me saying this, okay? And the reason I'm pointing this out, guys, is that I would rather, personally, now you have to make up your own mind how you want to trade and invest, but I am a very fact-based individual. I'm very pragmatic. I try to, as much as humanly possible, eliminate emotions from business and math decisions, okay? And investing is a mathematical equation. But I would rather be invested in cash, earning nothing, than being invested in something that is either losing me money or where the risk-reward ratio is so tilted against me that it just doesn't make any sense, okay? So the whole point of telling you this is, remember, cash is an asset class, all right? You're not making anything, but you're not losing anything either, okay? So you have to pick and choose your battles when investing. And I think, and this is based on my decades of experience, guys, I believe that trading and investing is harder now in some respects than it ever has been. There's more information available. The downside is, though, that the markets are so liquid and things move so fast that, and keep in mind, this downturn that we just been through since February 19th, right, that really started on February 20th, this was the fastest correction in history. And a correction, of course, is when you drop 10% from your previous all-time high. So this kind of backs up what I'm saying, all right? This was the fastest we'd ever gone from a peak in the market to a 10+% downturn, the fastest ever. So, and I don't think this is going to change. I think with ETFs, intraday liquidity, and just, algorithms, more computers than ever before working in the financial services area and in trading, I think this is the new normal, guys. We better get used to this type of very, very fast price action change. And remember, the market takes the stairs up and the elevator down. So the elevator down is going to go down really, really quickly now and in the future. And again, this is why, for my own personal trading and investing, I had to create simple market signals, because as good as I am at technical analysis, as good as I am at market analysis, I needed something it took me over 20 years to figure this model out, but it flat works. And I'm sharing it through the newsletter, right? The signals come out every weekend via the newsletter, and then special midweek updates when necessary. But it's less than $20 a month, guys. So for most of you, it's costing you money not to be a subscriber to my newsletter. And it's just, I mean that sincerely, right? I mean, it's really, really good information. And by the way, just so you understand, I have more financial advisors that subscribe to my newsletter than non-financial advisors at this time. But it's open to the public. It's less than $20 a month. It comes out every week. It's emailed to you, right to your favorite in basket. And let's just look at this real quick, and then we'll move on. I just want to make the point that, again, when you're looking at an ROI, a return on investment, there's always a cost to something, and there's a cost to not doing something in business, okay? And let's say you just have $3,000 in the market. That's all you have, maybe in an IRA. Well, if you're down 12% on a $3,000 investment, you just lost $360, right? My newsletter is less than $240 a year, guys. So, and again, I was warning people back in here to get out, right, or to at least take profits. And then this was the first signal change, and this is when the signals change, and again, you'll need to subscribe to make so this all makes sense. But this is where people could have gotten out, all right, or at least take that was even if they didn't heed my warnings up here to rebalance, take profits, all the things I was saying. This right here, on the 24th was an easy exit for most people that are subscribers to my newsletter. So I just want to make sure you guys understand that it literally is costing you money not to subscribe to this, guys. And look, there's no contracts. You can cancel anytime. Your first 2 weeks are free. I really, really love helping people. I want you guys to succeed. I want you to succeed with, and have a great association with me and enjoy working with me, enjoy watching my videos, enjoy my newsletter. It really is important to me. So that's why I'm really kind of hammering on this, so you really understand what the lost opportunity cost is for you in not being a subscriber to my newsletter. And let me help coach you through these volatile times and going forward in investing, because guys, it's not going to get any easier. Okay, based on my experience and based on what I see, it's not going to get any easier going forward. And in the next session, I'll really drill down on some of the bond stuff, because you'll understand that where bonds have really helped offset equity risk in the past, they're not going to be in a position to do that going forward based on the math. And we'll talk more about that in the next session. Before we move on, however, I promised you guys I would take a look at some other time frames real quick on these investments. So we know what's happened over the last 13 trading sessions, but let's just back this up and look at a couple different trading sessions, a couple different time frames. So over the last month, the last 21 days, so now we're February 6th of 2020 through March 6th of 2020, we can see here that S&P 500 via the SPY, SPY, which is the largest ETF in the space that helps to replicate and track the S&P 500, because keep in mind, you can't invest directly in the index. So a lot of people talk about, I'm going to invest in the S&P 500. Well, technically, you can't invest in the S&P 500. You can invest in mutual funds and ETFs that track or help, or try to track the S&P 500, but technically, you can't invest in the S&P 500 directly. And by the way, I've got a really good video on the difference between the S&P 500 ETFs and mutual funds that's out on my YouTube channel, so check that out if you haven't seen it, because it puts to rest the differences between all those things and where you might want to use one versus the other. So we know over the last the last 21 days, last month, that we're down 10.93% on the S&P 500, the SPY. We're down 11.64 on the DIA, which is the Dow Jones Industrial Average. And by the way, just a real quick thing on diversification. People say, I've got both the Dow and the S&P. Well, guys, there's 30 stocks here. There's 500 here. So technically, you're more diversified by just buying the SPY, all right? And then you've got the triple Qs, which is the NASDAQ 100, and it's going to be much more aggressive, right? There's more biotechs and the large tech stuff in there. No financials, utilities, things like that in here. So if you want the real hot version, if you will, that's going to kind of should outperform over time, the triple Qs should over time have better performance than these other two. But just keep in mind, the trade-off is there's going to be a lot more drawdown and volatility over most time periods. So we're down 9.63% on the triple Qs over the last 21 trading sessions. The EEM down 873, the FXI down 329, and the MSCI World XUS index down 10.94. Again, intuitively, on the 50 large caps, at last count anyway, 50 large caps in China, down 3.29%. That doesn't make any sense, right, given what we're going through. But this is also why we have to do this analysis. So that's not to say the FXI always outperforms on a relative basis, but over the last 21 trading sessions, it has, again, given the fact that from what we know, the coronavirus epicenter is China. This doesn't make any intuitive sense. but it's the facts. So that's why, I try to, I always want to look at the facts, right? Let's go back 3 months and see what has happened real quick here. So we're down a little over 5% on the S&P 500. I'm just going to go real quick on this. Down 7%, more than 7% on the Dow Jones Industrial Average. Triple Qs are up 1.69%. EEM down 484. FXI down 0.54, just over a little over 0.5%. And you can see here that the MSCI World XUS, I can't say that today, the MSCI World XUS index is down 8.32% in the last 62 trading sessions, which again represents the last 3 months. Now, real quick here, let's go back 6 months, and we can see here that SPY is up 0.76%. The DIA is down 2.45. We've got a positive return of 9% on the triple Qs. The EEM is down a little over 0.5%. The FXI is up a little over 1%, and we're down 3.75% on the rest of the world, if you will, using the MSCI World XUS index to represent that. And then lastly here, let's just look at the last year, and then we'll move on to the next session to talk about S&P 500 versus gold and miners and also bonds. So here the S&P 500 is up 9.29% over the last year, right? The last trading year, which again, we're going from the 6th of March of 2019 through the 6th of March of 2020. So we're up 9.29% on the S&P 500 there via the SPY. The DIA, which is the Dow Jones Industrial Average, up 3.03. We have a very nice return on the triple Qs, up 20.84%. And by the way, guys, I am not trying to make any I'm not trying to get you to invest in one thing over another. I'm just educating you on how this stuff works. So on a relative basis, things go kind of in the same direction at the same time, right? That's called correlation. But you can definitely get some outperformance over different periods of time with different investments. So hopefully this is helping you understand how this works. For most people, the S&P 500, I mean, I just know from a mathematical standpoint, that's where most people invest, and there's absolutely nothing wrong with that. The triple Qs over time will more than likely outperform. However, most people won't be able to stomach the volatility of this thing. So just understand that, okay? Because it's just got the hottest areas, of the U.S. Stock market in it. And so it should technically outperform, right, over time. But there are times where the volatility will be just absolutely brutal. Again, that's where, simple market signals could help because it deals with the entire U.S. stock market and it deals with risk and it's systemic risk, which, again, if you want to learn more about how all this works and how you can benefit, I will tee up a video at the end of this video for you to watch. But so triple Q's up 20.84% over the last 254 trading days. Again, we can see that right here. The last year, the EEM is down. So this is what I was talking about earlier, right? So over the last, since we peaked and just during this downturn, emerging markets and the FXI, the Chinese large cap, have outperformed on a relative basis. Again, it doesn't make any intuitive sense, right? Because as far as we know, the epicenter for this coronavirus, which to a large degree, now it's never just any one thing, guys, in any one thing, but to a large degree, from what we know, this downturn, a lot of it has been because of the coronavirus, okay? And it definitely could get a lot worse before it gets any better, okay? We don't know for sure. That's the part of the problem is the unknowns here. But what I'm pointing out here is that over the last year, you've got a 9% gain in the S&P 500. You've got over 20% in the triple Qs, and yet you're down 3%, 3.35% in the EEM, and you're down almost 7% in the FXI. So it depends on the time frame that we're looking at as to what investments are going to do best. And again, if you're quote unquote diversified into the rest of the world, because all the talking heads on financial shows say, oh, you have to have diversification, that's going to help you. Keep in mind, guys, and go out and Google this. Fact check me, okay? Because I want you to really understand this stuff. I want people that are associated with me to win. I want to help you guys win. I want you guys to be some of the smartest investors on the planet. And I mean that sincerely. I want to help you. It's important to me, okay? Maybe it's my ego. I don't know, but I just want you to win, okay? But what I'm trying to point out here is diversification, and go fact check this because I want you to really own this information. Diversification reduces stock-specific risk. However, it doesn't reduce or eliminate systematic risk. And this drawdown, okay, this is super important for you guys to understand. And most people have no clue what systematic risk is. Okay, and systematic risk is also known as volatility, and it's also known as market risk. And it's everything going down together. It's the system, okay? Systematic risk. Kind of think about just what that word represents in the terminology. So it's the entire system, the entire equity system, the entire global equity system going down, up and down together, okay? And you can't diversify yourself out of that, okay? You can dilute yourself silly through diversification and kill your returns. Think about what I just said there. You can dilute yourself silly and kill your returns through too much diversification, okay? Diversification is good. Too much diversification, not good, okay? It becomes dilution. You're diluting your returns, okay? Just understand that, and look this up, please. I want you to own this. Systematic risk is undiversifiable risk. You cannot diversify systematic risk. Historically, and we're going to get into this in the next session, we'll talk about some of this, but the systematic risk has generally, for decades, been mitigated to a large degree by using high-quality government bonds in a quote-unquote portfolio to help offset equity risk. So if you have a 60-40 or 70-30 portfolio, 60% of your portfolio is in equities, 40% bonds. Or if you have a 70-30, it's 70% equities, 30% high-quality bonds. If it's constructed properly, okay, the high-quality bonds. And historically, those have kind of counterbalanced each other, okay? So, but what has happened in the bond market, guys, is so scary now. I think the bond market is absolutely the scariest thing in financial services. I'm not trying to be overly dramatic, but I'll show you this in the next session because it's super important for you guys to understand this. We've got a major problem, guys, in the bond market, and I mean, they could keep this. They, being this, central bankers, could keep this party going for a long time. But this isn't good. There's no way this can end well with the bond market. Okay, so to control your systematic risk, your market risk, your volatility going forward, you're going to need a system. Make sure that you don't experience massive drawdowns, which are completely possible with what we're going through right now. We may not have seen the worst. I don't know. And we'll talk about this in session 4 for sure. But we may not have seen the worst of this downturn yet, okay? We don't know. We don't know how bad this thing can get. And that's the real scary thing is there's no clarity on this from anybody. This is a scary, scary time, okay? So don't underestimate the risk that's in the markets right now. But whether you're going to choose to work with me via subscribing to my newsletter, or if you're going to do it on your own, you better have, this is for your benefit, guys, you better have a risk mitigation process in place. And in the short term, as you'll see in the next session, bonds have worked out pretty well. But long term, I think the bond market is probably the scariest area of financial services. And again, we'll check that out in the next session.